What's up, everyone? My name is Ali. Welcome back to my world of stocks. Now, as a stock market YouTuber, one of the most common complaints that I often get from beginners when it comes to investing is that stocks are just a bit too expensive. They're usually out of reach for most people. Regular folk just can't really benefit too much from stocks. It's really meant for rich people with a ton of disposable income that know exactly what they're doing. And this is a concept, a line of thinking that I've always hated. I've always strongly disagreed with it because I feel that it's a way of keeping people down, keeping people poor, keeping everyone afraid of stocks, keeping them from using what is, in my opinion, one of the greatest inventions in human history. I mean, the fact that regular people like you and me can become part owners of giant corporations like Microsoft or Amazon with no education, just by the push of a button we can buy stock and be a co-owner of Amazon or anything else, I think is incredible. And I think it's a very useful tool for building long-term wealth. So in today's video, I'm going to show you just how incredibly easy it is to get started with stocks. I'm going to hypothetically take $100 budget and I'm going to build a very well-rounded, well-diversified portfolio that I think can be set up for great long-term success, a portfolio that I think can easily be added to over time. Whatever the budget is, it doesn't matter. We're starting with just $100. I'm going to show you exactly what stocks I would buy and by how much every single stock and what my strategy would be for the entire thing. Now, of course, this is not financial advice like all of my videos. This is just me sharing my opinion. You always need to do your own extensive research and make your own decisions. This is just hypothetical. If you tell me, hey, here's $100, you've never owned any stocks, you're brand new, you're a beginner, what stocks would you buy? How would you build out your very first kind of starter portfolio at today's prices? What stocks would you pick up? That's going to be the focus of this video, and it's going to be a ton of fun. So I hope that you're excited. Hit that like button, subscribe, but this is how I would do it. So the first thing I would do is I would download an investing app like Robinhood or SoFi that has commission-free trading with fractional shares. Because if I can eliminate fees, that means I can keep all of my limited investing budget of only $100 and it can all go straight into the stocks that I want to buy. And with fractional shares, I can buy any stock I want for any dollar value I want, and it doesn't matter what the price of the stock is. I can use my $100 however I want, spread out across any stocks I want. And those are very useful tools for a beginner with a limited budget. It's perfect for that. Now from there, I would start planning out my strategy, and I'm going to keep this as very short and simple, as beginner friendly as possible. But what I would do is I would break up my portfolio into 4 subcategories that are very easy to understand. Now, the first of those will be my core foundational stocks category, which I'll allocate about 1/3 of my portfolio to at $33, in other words, 33%. These are meant to be my safest investments that give my portfolio a lot of long-term reliability and can act like the glue or the foundation of my entire portfolio. And I'll take at least 3 stocks here to start. From there, I'd make another category for dividend stocks, and I would actually put even more money into this category at $37 spread across 6 different stocks. And the reason why I'd go so heavy here is because if I'm a brand new investor that needs to build out my portfolio from scratch, then the biggest thing that I need to rely on is time and growth. I need this portfolio to get bigger over many years. At all costs, that's my main priority. And so dividends is actually one of the best ways to do that, as I can consistently collect dividends every quarter, and then I can reinvest those dividends right back into my portfolio. So even though I'm on a budget or my work income is low, my portfolio itself can actually start generating passive income for me and actually grow itself larger over time on its own. That's huge for someone on a budget. Now, next up, I would take about 1/4 of my portfolio, so $25, and I'd put that into 4 additional stocks that offer at least some value or some growth. They may not be as reliable as my core stocks or pay a meaningful dividend, but they're still stocks that are worth investing in at smaller amounts, so I would put them right here. And then finally, I'll take just the last 5% of the portfolio and put that money into some high risk, high reward stocks, what we typically refer to as speculative stocks. And these are just going to be a little bit, higher risk of losing money, But with 5 stocks at less than 1% each, they really can't do much damage to my portfolio. And because they have a lot of upside potential over the long term, they could actually, double, triple, or quadruple in size if I happen to pick a few winners. So they're still worth betting on, even though they do carry some higher risk. All right, now starting with the core foundational stocks first. These are really easy for me because there's 3, I would say, no-brainer giants that I would immediately pick up in Google, Amazon, and Microsoft. And at today's prices, I like Google the most, so I'd give that $12, then $11 for Amazon, and $10 for Microsoft to give me that $33 total. These have gigantic businesses, with Google dominating virtually everything related to the internet, Amazon dominating everything related to online shopping, and Microsoft everything related to business, with all 3 of these also overlapping in areas of cloud computing, artificial intelligence, and a ton more, which are markets that I want as much exposure to as possible. Plus, they have huge financials. I mean, Amazon, for example, already does over $500 billion in sales per year, yet they're still growing at a double-digit rate, which is incredible. Microsoft does over $70 billion in profits and is still growing at a double-digit EPS rate too. And while many investors avoid these giant behemoths because of their expensive price tags, the fact is that their valuations are not as crazy as you might think. In fact, Google actually trades cheaper than the sector by almost 15% on a forward PEG ratio basis. So overall, just great foundational stocks, I feel, for the long term. Next up, though, will be the dividends, which I'd want to make up a little more at $37 across 6 different stocks. Admittedly, these will carry some higher risk, but I feel that the trade-off is worth it, as these are market leaders with cheap prices and some of the most attractive dividends out there. Verizon, for example, is a leader in telecom and internet. Medtronic is the world leader in medical devices. Pfizer is a world leader in biotech pharmaceuticals. US Bancorp is one of the biggest banks in the world. Walgreens is a leader in pharmacy, retail, and healthcare. And Tyson Foods is a world leader in meat and poultry products. From the highs, all of their stock prices are currently down close to half or even more of their entire values at the time of this recording, which has caused their dividend yields to rise to some of the highest levels in their history, with Medtronic and Tyson above 3%, Pfizer above 4%, USB above 5%, Walgreens above 6%, and Verizon above 7%. And the valuations are also significantly cheaper than the sector despite their market leadership, with Pfizer, for example, trading over 50% cheaper on a forward P basis, while Verizon is over 60% cheaper as well. I would give a little more weight to Verizon and Medtronic at $8 each, followed by Pfizer at $6, and then $5 each for the rest, because I like the really high dividend yield of Verizon, and I like Medtronic's business the most, and I think Pfizer is heavily slept on right now, so that's how I'd balance out that spending right there. Up next, though, I'd put about a quarter of the portfolio into a mixture of value and growth-oriented stocks, with Disney getting $8, Meta getting $7, and both Tesla and Nvidia getting $5 each. And right away, you can see how these have either a growth or a value proposition to them. Disney, for example, is, in my opinion, the biggest pure play entertainment leader in the entire world, with some of the most iconic brands ever, and yet the stock has actually lost more than half its value recently and is trading almost 40% cheaper than the sector on a forward PEG ratio basis because of the future profitability that will eventually come over time from streaming. Meta, I feel, is a bit more of a kind of small mixture of both value and growth, since the stock is already up over 150% this year, but is still over 20% cheaper than the sector on a PEG basis. While they already have like half the world's entire population using their social media apps, they have future growth potential in the metaverse. They already generate gigantic profits, doing over $50 billion in operating cash flow just the past year alone, and they're expected to grow EPS by almost 20% a year over the next 5 years. Now, granted, Tesla and Nvidia are trading very high right now and have never really been considered to be even close to what a value stock is, but they absolutely qualify for growth, with Tesla dominating the electric vehicle and autonomous driving markets, which is the future of the automotive industry, while Nvidia is a huge play on the future of artificial intelligence, with even a new report from JP Morgan recently estimating that they'll generate the most AI related revenue of any other company this year. That's pretty crazy. Again, these are a little higher risk than I would like, but they're also pretty solid in the specific things that they offer, and I think they're worth having a small piece of regardless. Speaking about risk though, I would then put the final 5% of the portfolio into some high risk, potentially high reward stocks at just around $1 each, so that I'm not too heavily exposed to any of them, which will make it easier to buy more in the future if they fall, and thus I can lower my cost basis without stressing too much about it. I always do that with small, speculative stocks. I buy very small, and then if they go down, it's very easy for me to double, triple my position, lower my cost basis, makes it so much easier, and it lowers the risk a lot. But here, I would spread it evenly across Alibaba, Baidu, SoFi, Palantir, and Teladoc Health. All of these I feel present huge future potential, as the Chinese Alibaba and Baidu give the same type of exposure to AI, internet technology, e-commerce, and cloud computing that I would get from my core stocks like Google, Amazon, and Microsoft, except these are the riskier Chinese versions of that. SoFi is a fintech and an all-in-one platform for things like banking, investing, lending, and much more. Palantir is a huge play on the use of AI for data management with a growing customer base across not just corporations, but even the government and military. And Teladoc Health is a leader in telemedicine, which I think is the future of healthcare. So that's how I would do it, guys. That's how I'd build out a first kind of starter budget portfolio right now at today's prices. Not as hard as it looks, right? I mean, I came up with these stocks fairly quickly. I do own all of these stocks in my own portfolio, so I know about them. But, if you do your own research out there and you look for the stocks that are right for you, you'll find those stocks too. And you can build a well-rounded portfolio very easily. And it doesn't matter for how much you start with. It can be just a small amount. It can be a budget portfolio to kick things off. And then over time, you can build it up and you can have long-term financial success. So anyway, I hope you got something out of it, especially if you're a beginner. I hope you enjoyed the video. Let me know your thoughts. Do you agree with my style, my picks? Would you make any changes? I'd love to hear your thoughts down in the comment section. And if you're a beginner, you maybe consider subscribing to the channel, because we make stock market videos all the time, and I think you'd have a lot of fun and really enjoy them here, and I'd love to have you. So anyway, thanks again for stopping by, my friends. I hope you're all doing well, and I will catch you in the next video. Take care, everybody. Bye-bye.